Hey everyone, welcome to my channel Beyond Balanced Books. In this series of videos, I am going over all the accounting concepts. Everyone, mostly if you went to school for accounting, starts with this, but as a beginner, I knew them by heart during my fundamental accounting classes and completely forgot about them by the time I graduated. And when I started working in accounting, I started connecting a few dots between these concepts in real life accounting here and there. This is an attempt for me to go back to the basics because the deeper your understanding are in these concepts, the better you can explain yourself to accounting and non accounting individuals reasons for why certain transactions have to be booked a certain way without coding the accounting standards, hopefully. So, without further ado, let's start our first accounting principle. In this video, we will go over the accrual accounting concept. So let's begin with the overview of what we will cover in this video. The first thing we will do is define the concept. The second thing is why is it important? And the third thing is how do we do it in the day-to-day accounting? So what is this accrual concept? It's an accounting method in which expenses and revenues are recorded as incurred. What that means is you record the transactions as and when the goods and services are exchanged. We don't look at when the cash is exchanged, we only look at when the transaction occurs, as in when the goods and services are exchanged. I have given a few examples here. The first example is of a restaurant that opened but have not received its utility bill yet. So the product, which is the utility, they have been using the electricity and water, but they have not received a bill yet. In this situation, an accrual is required because they were open, they used the utility to obtain the revenue that they did obtain during those periods that they have not been billed yet. The second example here is for an accounting firm that has already rendered the services and actually billed the customer. The payment gets received in January, which doesn't really matter because the service was rendered in December, so the revenue is actually booked in December. So, why is it important? We are going to go through these topics one by one in just a moment. So, firstly, it conforms to GAAP. GAAP is a generally accepted accounting principles. Usually, when FASB or GASB publish various accounting standards, those are based upon these basic concepts. So understanding the basics will help us understand the various accounting standards or codes that have been published by FASB and GASB. When we speak about GAAP compliance for large corporations, we are usually talking about the standards that are the guidelines on how transactions universally get booked, regardless of what industries the business operates on. The ASA standards are also sometimes published specific to an industry and might not apply to other industries, but in a nutshell, the core concept usually is maintained while publishing these standards. Not only that, it also aligns with other accounting concepts like the matching concept and the revenue recognition concept, which we will go into further detail when I cover those topics. But if you understand the accrual concept, the understanding of the matching and the revenue recognition concept also becomes a lot easier. The next reason I have mentioned on here is the accuracy and consistency of the financial statements. Because both revenues and expenses are being booked as they incur in each accounting period, the financial statements are more consistent and hence more accurate. Also, the comparison and measurement of how a business is doing makes a lot more sense as we are comparing apples to apples when we are doing the trend analysis and so on. Also, as it is important to diversify for business owners, the KPIs and different liquidity ratios are more comparable even within businesses from different industries, as this concept is followed all across the board. Before I move on to the how and the rest of the video, I just wanted to cover these two terms, accruals and deferrals, because that used to confuse me a lot when I was a beginner. Accruals are usually they usually affect both your income statement and your balance sheet. And deferrals usually just affect the balance sheets and don't have any kind of impact on the income statement. So when you are accruing a revenue, what you are basically doing is booking accounts receivable in the balance sheet, and you are booking a revenue in the P&L. When you are doing an accrual of expenses, you are booking the expense in the P&L and the accrued liability in the balance sheet. Whereas when you do the deferred revenue, when you say deferred revenue, that means you are being prepaid for a service or goods you have not provided yet and you'd have to provide in the future. It's a liability, so it sits in the balance sheet and you probably received cash, so it also affects another balance sheet account. Similarly, for the deferred expense, which you paid an expense in advance, so it definitely affects your cash and it affects the prepaid expense in your balance sheet, which is also a current asset in the balance sheet. So hopefully this helps, because I used to get confused a lot. Now, moving on to the hows, the simplest answer for it is it's done through a journal entry at the end of the month or at the end of the year. You'll figure out how much or what needs to be accrued, and you pass an adjustment journal entry. This is the journal entry that we usually do. As I mentioned earlier as well, the accrued revenue don't go through the journal entry. If you are using QuickBooks or any other accounting software, as soon as you go into the customer and create the invoice, this entry that is here is already generated in the back end. You don't go and book journal entries into accounts receivable. It's one of the control accounts that you don't usually put journal entries into. So that brings us to entry number one. The entry number one is what is usually done for the journal entries to book the expenses. The entry is not that hard, as you have seen. What is more complicated is how do you come up with the numbers or the amount for that entry? Where do we get the amount? How do we accrue? When do we know what expense to accrue? That would be the question that most of us, in the beginning would wonder and not really know how to go about it. I am going to mention 3 different ways that I have been able to figure out what to accrue for and how much to accrue for. So these are one of the few methods that I use personally when I'm doing accruals. One way to do it is by using the trend analysis. So to run your income statement, hopefully your AR and AP, everyone is done with what they are supposed to do. The AP is done with your vendor reconciliation and all the statements have been received and they know exactly what invoices are missing and whatnot. The AR is done with all the customer invoicing and everything. So the only thing you are left with is the accrual accounting. That's the assumption I'm making. So here what you do is you run your income statement, you do a trend analysis month over month or quarter over quarter, and you see what expenses are really low or missing. And based on that, you go and investigate if a certain expense is missing or a certain invoice is missing from a vendor that usually invoices you. Then what you will have is a list of expenses that you will have to accrue for that month, and you will go ahead and accrue. The second way to do it is to keep a schedule of all the accruals that you have made. So it is a running schedule of everything that you have done over the months. and you see exactly what had been accrued in Jan, what had been accrued in Feb, what was reversed, what was not reversed, and all of that. Keeping this helps a lot with if you have an audit or if you have to provide this to anyone that's looking at your balance sheet as to what makes up your accrued liability number. So it can be a very helpful tool when you have to reconcile your balance sheet. Also, it allows you to see or remember what has to be reversed periodically, as and when you receive those invoices. So I have found this to be very helpful. And the third thing on the list is pretty simple. It's to talk to different departments, because if you speak to a CFO, he might know some kind of professional services were rendered beyond your knowledge. They could have used a lawyer to do something that was not brought to you or you didn't know about it. So if you go to them and ask them what are they expecting, they would be able to help. Same thing with purchasing. If they are, they bought something they already received but they are waiting for a bill or something like that, you could speak to different departments and figure out what needs to be done. And the final point to be noted is that the accrual is basically an estimation of what could be the expense based on your prior bill or whatnot. So it's not going to be 100% accurate. It's going to be close to, or that should be the goal, to get to the closest accurate number. There is a big con to this concept as well, because sometimes you would book a revenue and then the customer goes bankrupt or something and he doesn't pay you, and you only find out like 2-3 months later. When that happens, you would have already booked the revenue, and in those cases you'll have to kind of figure out what, like, the materiality, like how much are we talking about basically. And if it's really material, then you might have to speak to your CPA or to your CFO or whoever you are reporting to understand if it can be done through an adjustment, or it has to be, you have to go and revise your accounting financial statements. Well, that's the end of this video. Thank you so much for watching this far, and stay tuned for the rest of the other accounting concepts. Thank you.